The other thing, well, I think there's two more things that make this different, pardon me. The first is the incredible sum of the net present value of unfunded entitlement liabilities, the off-balance sheet liabilities of the U.S. government, the promises that they've made to old geezers like me. That number, according to the Congressional Budget Office, exceeds $120 trillion. To put that in perspective, the gross federal income is $5 trillion. That's a fairly ugly mismatch. The second thing that's different now, Trey, I think, is the dawning realization that United States savers are experiencing negative real interest rates. If you follow the theory that gold does well when people are concerned about the maintenance of purchasing power in the US dollar, if you believe in the CPI, which neither you nor I believe in, the government would suggest that your dollar is declining in purchasing power by 2.9% compounded.
A cleansing conflagration has recently occurred in the silver market. Momentum junkies were eliminated by leverage speculators. And yet, Rick Rule, one of the most esteemed investors in the resource sector, maintains that this is not the conclusion of the silver bull market. It is merely the initial phase prior to the actual maneuver. He cautions that the long-term upward trend will not be disrupted even if silver falls from $50 to $40. It will merely eliminate the latecomers who joined during the most recent surge. Silver pays rent unlike any other asset on Earth when it truly moves, as Rick describes it. In this video, we will examine the taking out the trash phase, as Rick Rule refers to it, during which disciplined investors discreetly position themselves for the subsequent leg of this historic bull run, while over-leveraged speculators are destroyed.
I'm not ducking the question, but I don't know. I feel very good about the whole precious metals complex for the next 5 or 10 years. I'm leery about hockey stick charts. The backside of a hockey stick is just as steep as the front, but somewhat less fun if you're long. You're, Trey, I think, a better observer of markets than I. My experience has been, going back to 3 prior bull markets, that precious metals bull markets are always led by gold. They're led by the fear buyer. My belief is that when the narrative is justified by the price momentum in gold, and the generalist investor begins to come into the space, that silver begins to outpace gold substantially. I'm guessing that what we've seen in the last 4 weeks is the beginning of that phenomenon. But I would actually defer to you in terms of that. I note, and Wealthion may know this better than I note that many retail physical silver dealers have run out of retail product in silver. I know that I have, and Sprott has, and likely you have, been able to buy silver in larger denominations, at least in the US and Canada, albeit not in London. So I guess what I'm saying is don't count on the sort of performance that we've seen in the last month continue on with the same velocity. But I absolutely, positively believe that the precious metals bull market is very much intact, albeit it's going to be volatile. As you know, Trey, it has been for our whole lives and will continue for as long as we have left. That you and I had 5 or 6 years ago, we were saying, when is this going to happen? And I suspect that what we're seeing is the metals playing catch up. I suspect that pressures were building against fiat denominated savings products, US treasuries and things like that, for years. They were building, but because they were performing, the products held up well. When those products, being fiat denominated savings products, 10-year treasuries as an example, faltered, they faltered in spades, and they gave up what I might consider long of tooth gains. So I think that Trey, we're experiencing in 2024 and 2025 pent up fundamentals that go back at least 7 or 8 years, but particularly go back to 1999. I would also ask your listeners to consider the longer term performance of gold going back to, say, the year 2000. I remember answering many interviews a few years ago when people say, well, when is gold going to move? I would say, well, I think it's going to move in the year 2000. At that point, it was up 7% compounded for 20 years. Now it's up 9% compounded for 20 years. What it's done in the last year gets the headlines. The other thing, well, I think there's two more things that make this different, pardon me. The first is the incredible sum of the net present value of unfunded entitlement liabilities, the off-balance sheet liabilities of the U.S. government, the promises that they've made to old geezers like me. That number, according to the Congressional Budget Office, exceeds $120 trillion. To put that in perspective, the gross federal income is $5 trillion. That's a fairly ugly mismatch. The second thing that's different now, Trey, I think, is the dawning realization that United States savers are experiencing negative real interest rates. If you follow the theory that gold does well when people are concerned about the maintenance of purchasing power in the US dollar, if you believe in the CPI, which neither you nor I believe in, the government would suggest that your dollar is declining in purchasing power by 2.9% compounded. But they buy their groceries, their goods and services, in hedonistically adjusted grocery stores, which are not available to us. I would suggest that the purchasing power of your savings and mine is declining at about 8% compounded. And the arithmetic problem there is if you're saving at fiat denominated instruments, let's say the US 10-year Treasury, the world's benchmark security, you're getting 4.6, paid 4.6, pardon me, in a currency that's declining at 8. That means you aren't making 4.6. You're losing 3.4 every year for 10 years. There can't be a circumstance in the long term that is better for gold than that.
At the outset, Rick Rule presents a straightforward truth. In a secular bull market, short-term volatility is irrelevant. Investment demand is the primary factor that propels silver. The disparity between consumers and sellers. The catalyst for each significant silver bull in history was not industrial demand, but rather investors' loss of confidence in paper assets and their subsequent pursuit of tangible assets. He refers to silver as a monetary metal that is dressed up. Throughout South Asia, including India, Pakistan, Bangladesh, and Sri Lanka, millions of individuals utilize silver as both an informal unit of exchange and a store of value. For those who are priced out of gold, it is genuine currency. Silver's monetary essence is derived from this ancient trust. In contrast to gold, which is widely recognized as having an above-ground supply of approximately 216,000 tons, silver remains an enigma. It is impossible to determine the total stockpile with precision. Warren Buffett once held up to 20% of the world's known silver supply, which caused a price surge until unexpected hoards emerged in India when locals sold to survive a poor harvest, as Rick recalls. It was demonstrated by that event that the actual supply of silver is highly unpredictable. The majority of silver is not extracted directly. It is generated as a byproduct of the mining of copper, lead, or zinc. This implies that even the most exorbitant prices do not necessarily result in increased production. It is one of the most peculiar and restrictive metals in existence. Recent data has now verified this. The cost of borrowing tangible metal, known as silver lease rates, has increased from the standard 3 to 4% to over 30% in certain contracts. That is a red alert signal that indicates a severe physical pressure. This is the consequence of flushing out speculative waste, according to the rule. Traders who employ a 10.1 leverage ratio are unable to endure financing costs of 35%. In the interim, gold has maintained its position at or near record highs, despite the cooling of silver, demonstrating the ongoing erosion of investor confidence in fiat currencies. Rule's thesis is further supported by the most recent inflation data, ongoing central bank bullion purchases, and record-high U.S. deficits. Precious metals are not merely commodities. They are monetary lifeboats. Rick references Pierre Lasson's objective of 17 to $210 in gold by 2030 in the event that the dollar loses 75% of its purchasing power. In the event that history is repeated, silver has the potential to double the percentage gains of gold, as it has in previous cycles. He concludes that the emotional volatility of silver is precisely what renders it so combustible. Overnight, small groups of traders have the ability to either send it soaring or crashing. However, for long-term investors who comprehend its monetary influence, that volatility is the source of their wealth.
Now, I've been aware of the arguments around the physical utility of silver for a very long time. I remember when photographic demand went away. And I remember in the middle of photographic demand going away, one of the damnedest spikes I've ever seen in the silver market. It was really difficult for me to explain that away in any other way than observing the fact that in the investment market, there was a lot more buyers than sellers. And I understand the implications of increasing photovoltaic demand. I understand the incredible implications of silver's efficacy as a water treatment item or anti-germicide. I get all that, and I think it's important. But it would appear to me that what generates real price moves is simply the imbalance between buyers and sellers. I think maybe the second thing that makes judging silver pricing as a function of industrial demand difficult is the fact that on the supply side, most silver doesn't come out of silver mines. It comes from recycling or it comes from a byproduct of other metals. So you have this weird thing with silver that when the silver price goes up, it doesn't necessarily stimulate supply. An increasing copper price or zinc price or lead price might stimulate supply, but an increasing silver price doesn't seem to do that. It might encourage more recycling. I think it might be a monetary metal in drag, but I note that one of the functions of a monetary metal is that savers believe that they can, if they need to, transact in it, but it is also a store of value. And that's an important aspect of silver, particularly in South Asia, Pakistan, India, Bangladesh, and Sri Lanka, where people have 1,000 years of experience with the debasement of government currency. People, when they can, often choose to store their wealth in precious metals. And for a couple 100 million people in South Asia, the unit cost of gold is too high. They store their wealth in silver. And in that sense, it is a monetary metal. And I happen to know from having been there, but also watching the behavior of South Asians in Dubai, that not only is it a store of value, but it is in fact a unit, an informal unit of exchange, which is the definition of a monetary metal. For 20 years, Trey, and my track record is unblemished by success. I remember back to the point in time when Buffett was believed to have between 15 and 20% of the world's above ground supply of silver. And of course, normal tightment plus Buffett's cachet caused the silver price to escalate fairly dramatically. And then it got crushed. And I remember the silver bull saying it was another example of manipulation. What it was in fact that the silver price doubled in US dollar terms. The US dollar doubled against the rupiah, and they either had a flood or a bad harvest or something in India. And the Indian peasantry had a choice between selling their silver or watching their kids starve. They made the correct decision, and a bunch of silver supply that nobody knew existed came on the market. And that event caused me to decide that I was never going to be able to decide what the above ground supplies were, and frankly, that I was never going to be able to time a silver bull market particularly correctly.
Mm.
I had to satisfy myself with the fact that silver moved after gold had established the narrative, and that if I was 2 years early, that the price movement in silver made being early not a problem. Silver pays so much rent when it moves that you can easily afford to be early and you cannot afford to be late. There as colleagues
Mm.
in the last silver squeeze. And at that point in time, North America was short of silver. And you may recall at Sprott that the Sprott Physical Silver Trust was growing ridiculously. And they cleaned out the silver in Toronto, then they cleaned out the silver in Ottawa, then they cleaned out the silver in Chicago, then they cleaned out the silver in New York, and they had to bring silver from London. Now we have a situation where London's out of silver, and so they got to clean out New York. But the other point you make is that there's a whole bunch of silver that isn't good delivery COMEX or good delivery LBMA silver, but it'll find its way in the system over time.
Right.
And by the way, if the silver price was to fall back from whatever it is today, 50 and change to 40, it wouldn't derail a precious metals bull market. It would change a whole bunch of people that got the religion of silver in the last 4 weeks and make them doubters, but that doesn't matter.
Right.
I mean, it'll matter to them if they get whipsawed, but it doesn't matter. The fact that silver went from 40 to 50 is only validation of the thesis for those people who needed validation. And were silver to decline from 50 to 40, that wouldn't matter much either. Not a problem. A 35% release rate, that's catastrophic. As you know, many of the traders are running 10 or 15% equity to assets. That does more than eliminates the margin. I think the lease rates that you quote, 35% for the near month, and 9, 10, 11% further out, talk a lot about the market's belief that, as you had suggested earlier,
Rick Rule's warning was exceedingly explicit. Stop observing the daily charts and begin to focus on history, as there will be insufficient time to enter the market when the subsequent phase of the bull market commences. The relocation will be swift, violent, and unforgiving. Therefore, I have the following inquiry for you. Do you think that the recent silver pullback is merely a temporary pause before a significant breakout? Or is it the beginning of something more significant? Please share your thoughts in the comments section. I am eager to hear your perspective. If you found this analysis to be valuable, please consider liking, subscribing, and activating notifications to ensure that you never miss another analysis of gold, silver, and the global monetary shift on Macro Edge. Because it is important to remember that silver rewards those who arrive early and destroys those who arrive late.